Securities lending is a well-established practice at the heart of modern capital markets. At its simplest, it allows investors to generate incremental income by temporarily lending out securities they already own. In return, the borrower pays a fee and the lender receives collateral to protect against counterparty risk. Here's how the process works. An investor makes securities, such as equities, bonds, or ETFs, available for lending. A borrower, often a bank or other financial institution, takes temporary possession of those securities to facilitate activities like short selling, market making, or regulatory balance sheet management. In exchange, the borrower provides collateral, usually cash or high-quality securities, whose value exceeds that of the loan securities. Both the securities and collateral are revalued daily, a process known as mark-to-market, to ensure ongoing protection for both sides. At the end of the transaction, the securities and collateral are returned, along with any agreed lending fee. Why do borrowers seek out securities? Banks are often obligated to provide continuous liquidity in certain assets. Securities lending gives them access to inventory they do not directly hold, ensuring markets remain liquid and transparent. Banks must maintain sufficient reserves of low-risk assets, such as government bonds. Borrowing through securities lending markets allows them to meet these obligations efficiently. Institutions borrow securities to support clients' trading strategies, to hedge exposures, or to cover settlement failures that could otherwise disrupt markets. Who are the lenders? Typically, long-horizon investors such as pension funds, mutual funds, insurance companies, and sovereign wealth funds. Because these institutions often hold securities for extended periods, lending allows them to put idle assets to work, generating additional yield without selling or disturbing their long-term strategies. What are the benefits? Lenders earn a fee that enhances portfolio returns. For pension funds and insurance companies, this extra income can offset costs and benefit end investors and policyholders. By providing a supply of securities, lending ensures smoother functioning of capital markets, reducing settlement failures and enhancing liquidity. Post-crisis safeguards such as collateralization, daily mark-to-market, and regulatory oversight help ensure that lending contributes to resilience rather than risk. Central banks themselves engage in securities lending as part of monetary policy operations, ensuring liquidity in government bond markets and helping stabilize financial conditions. Key considerations for investors. When securities are on loan, voting rights transfer to the borrower. This may not matter for most retail investors, but can be significant for institutions concerned with corporate governance. Loans are collateralized to reduce exposure, but lenders still depend on the creditworthiness of intermediaries managing the program. Lending income is typically taxed as ordinary income rather than dividends or capital gains, which can reduce after-tax returns unless managed through tax-advantaged accounts. Why does securities lending matter for the financial system? Beyond generating passive income for investors, it underpins market transparency, liquidity, and stability. It allows governments and companies to raise capital more efficiently, supports regulatory compliance for banks, and ensures that investors benefit from better price discovery. For these reasons, securities lending is not simply a niche strategy. It is a cornerstone of healthy functioning capital markets worldwide. In conclusion, securities lending offers a way for investors to enhance returns while simultaneously serving as an essential mechanism for market stability and efficiency. For professionals and institutions alike, understanding how it works and where the risks and rewards lie is key to participating in today's global financial system. Thank you for watching. If you found this helpful, don't forget to like the video and subscribe so you never miss our latest content.